The 2022 crypto industry crisis. The 2022 crypto industry crisis was the most severe collapse in the history of digital assets. Unlike the 2018 bear market, which was largely driven by the bursting of an ICO speculation bubble, the 2022 crisis exposed deep structural weaknesses across nearly every layer of the cryptocurrency ecosystem. What began as tightening global monetary policy quickly evolved into a chain reaction of bankruptcies, fraud, liquidity crisis, and investors' panic that erased roughly $2 trillion in market value. By the end of the year, many of the industry's largest firms had either failed, filed for bankruptcy, or been permanently damaged, fundamentally changing how investors, regulators, and institutions viewed cryptocurrency. The 2022 crypto industry crisis. By the beginning of 2022, the cryptocurrency industry appeared unstoppable. Bitcoin had reached an all time high near $69,000 just months earlier. Ethereum was setting records. Venture capital firms were investing billions into blockchain startups. Crypto exchanges were signing billion-dollar sponsorship deals, buying stadium, naming rights, advertising during the Super Bowl. Lending platforms promised annual returns exceeding 20%. Stablecoins claimed they had eliminated volatility. The phrase crypto is here to stay had become conventional wisdom. But beneath that confidence, the industry's foundation was becoming increasingly fragile. Years of near zero interest rates have flooded financial markets with cheap money, encouraging investors to chase higher returns in increasingly risky assets. Crypto became one of the largest beneficiaries of that era. Companies borrowed heavily, hedge funds leveraged their positions multiple times over, and business lent customers deposit to generate even greater yields. The entire ecosystem became dependent on continuously rising asset prices and an endless supply of new capital. Very few participants questioned whether the system could survive a prolonged downturn. When inflation surged across the global economy after the COVID-19 pandemic, central banks began revising years of easy monetary policy. The US Federal Reserve launched its fastest series of interest rates increase in decades, pulling liquidity out of financial markets. As borrowing became more expensive, investors shifted towards safer assets. Speculative markets began collapsing, technology stocks fell sharply, venture capital funding slowed, and cryptocurrencies entered a brutal bear market. What initially appeared to be a normal market correction soon revealed something far more dangerous. The crypto industry had built an interconnected financial system where the failure of one major institution could rapidly spread throughout the entire ecosystem. The crisis that followed would expose leverage, poor risk management, hidden liabilities, and outright fraud on a scale few had imagined. The Terra collapse that started the chain reaction. The first major domino fell in May 2022. With the collapse of the Terra ecosystem, unlike traditional stablecoins backed by reserves of cash or government bonds, Terra USD, known as UST, was an algorithmic stablecoin. Its $1 value depended on a mathematical relationship with a companion cryptocurrency called Luna. Whenever USD drifted away from $1, the protocol encouraged traders to mint or burn tokens through arbitrage, theoretically restoring the peg without requiring actual dollar reserves. For months, the system appeared to work. Billions of dollars flowed into the Terra ecosystem, driven largely by Anchor Protocol, which offered yields approaching 20% annually on UST deposits. Those returns attracted retail investors, institutions, and crypto funds from around the world. To many participants, Anchored looked like a high interest savings account. In reality, the yields were being sustained by subsidies rather than organic economic activity. Confidence, not intrinsic cash flow, was keeping the entire structure intact. The breaking point came when large withdrawals from Anchor and heavy selling pressure pushed UST below its $1 peg. Once confidence began to crack, the stabilization mechanism worked in reverse. Massive amounts of new Luna were created in an attempt to absorb the selling pressure. Instead of restoring stability, the rapid increase into new Luna's supply caused its price to collapse. As Luna became nearly worthless, confidence in UST evaporated completely. Investors rushed to exit simultaneously, creating a classic bank run in digital form. Within days, approximately $60 billion in combined market value disappeared. UST lost virtually all of its value, while Luna collapsed from over $100 to fractions of a cent as trillions of new tokens flooded the market. What had been promoted as one of cryptocurrency's greatest innovations became one of its largest failures. Thousands of retail investors lost life savings, institutional funds suffered enormous losses, and the credibility of algorithmic stablecoins was shattered. More importantly, the Terra collapse revealed that many of the industry's largest firms had concentrated enormous exposure to a single ecosystem. Those hidden connections would soon trigger an even larger financial contagion. Three Arrows Capital and the leverage explosion. The collapse of Terra didn't remain an isolated disaster. It exposed a far larger problem that had been quietly building throughout the cryptocurrency industry for years. Many of the largest hedge funds, ledgers, and trading firms were deeply interconnected through loans, collateral agreements, and leveraged positions. The same assets were often pledged multiple times across different institutions, creating a financial network where one major default could rapidly destabilize everyone else. At the center of this network stood Three Arrows Capital, commonly known as 3AC, founded by Su Zhu and Kylie Davis. The Singapore based hedge fund had earned a reputation as one of the crypto's smartest and most influential investors. At its peak, the firm reportedly managed billions of dollars in assets and maintained relationships with nearly every major lender in the industry. Banks, exchanges, and crypto lending platforms were eager to extend enormous unsecured or tightly secured loans because 3AC had built a reputation for consistently generating high returns during the bull market. As asset prices surged throughout 2020 and 2021, Three Arrows Capital became increasingly aggressive. The fund borrowed heavily from multiple lenders simultaneously while making concentrated bets on Bitcoin, Ethereum, Luna, Grayscale Bitcoin Trust, venture investments, and numerous decentralized finance projects. Success during the bull market reinforced the belief that leveraged amplified profits without creating unacceptable risks. Few lenders demanded sufficient collateral, and even fewer fully understood the firm's total obligation across the industry. When Terra and Luna collapsed, billions of dollars in capital disappeared almost overnight. Three Arrows Capital suffered catastrophic losses that it could not absorb. As cryptocurrency prices continued falling, margin calls began arriving from lenders demanding additional collateral. The fund lacked both the liquidity and the remaining assets to meet those obligations. Instead of stabilizing the situation, defaults began cascading across multiple counterparties at the same time. By June 2022, Three Arrows Capital had effectively become insolvent. Courts later ordered the fund to liquidate, revealing an extraordinary web of debt stretching across the global crypto industry. Companies that had confidently lent hundreds of millions of dollars suddenly realized they might recover only a fraction of their money. The failure of a single hedge fund immediately threatened exchanges, brokers, and lending platforms that had relied on its continued solvency. The crisis had evolved from a market crash into a full-scale credit crisis, where the central question was no longer whether cryptocurrency prices would recover, but which major company would fail next. Celsius, Voyager, and the digital bank runs. As Three Arrows Capital collapsed, attention shifted towards another vulnerable part of the cryptocurrency industry, centralized lending platforms. Companies such as Celsius Network, Voyager Digital, BlockFi had marketed themselves as the future of banking. Customers were encouraged to deposit Bitcoin, Ethereum, stablecoins, and other digital assets in exchange for attractive annual yields that often far exceeded those offered by traditional banks. Millions of investors believed they were simply earning interest on their holdings. Behind the scenes, however, many of these companies were operating with significant maturity mismatches and concentrated credit risks. Customer deposits were not sitting safely in reserve. Instead, they were being lent to hedge funds, market makers, decentralized finance protocols, and other borrowers in pursuit of higher returns. Much of that lending was backed by volatile cryptocurrency collateral, while some loans were extended with surprisingly limited security. As long as cryptocurrency prices kept rising and borrowers remained solvent, the model appeared profitable. But once market turned and the entire structure came under pressure, Celsius Network was among the first major casualties. As prices fell, customers rushed to withdraw their funds. The company faced a classic liquidity crisis. Like a traditional bank facing a bank run, Celsius didn't have enough immediately available assets to satisfy withdrawal requests because much of its capital was tied up in long-term investments and loans. On June 12, 2022, the company abruptly froze customer withdrawals, swaps, and transfers, citing extreme market conditions. The announcement sent shockwaves across the crypto industry. Millions of users suddenly realized they no longer had access to assets they believed they owned. Voyager Digital and even more Voyager Digital faced an even more direct problem. The company had extended hundreds of millions of dollars in loans to Three Arrows Capital. When the hedge funds defaulted, Voyager suffered losses so large that its balance sheet became unsustainable. Despite emergency financing efforts, the company filed for bankruptcy in July 2022. Thousands of customers found themselves trapped in lengthy legal proceedings, uncertain how much of their deposits they would ever recover. The collapse of Celsius and Voyager fundamentally changed investor psychology. The assumption that centralized crypto platforms were safer than decentralized alternatives rapidly disappeared. Trust, which had been the industry's most valuable asset during the bull market, evaporated within weeks. Customers across the entire sector began withdrawing funds from exchanges and lending platforms, fearing that any company could be the next to spend. Customers across the entire sector began withdrawing funds from exchanges and lending platforms, fearing that any company could be the next to suspend withdrawals or declare bankruptcy. What had started with the collapse of one stablecoin had now become a full-scale crisis of confidence affecting nearly every corner of the cryptocurrency industry. The FTX, the collapse that shattered crypto's reputation. Even after the failure of Terra, Three Arrows Capital, Celsius, and Voyager, many investors believed the worst was over. One company seemed to stand above the chaos. FTX had positioned itself as the responsible face of the cryptocurrency industry. Its founder, Sam Bankman-Fried, appeared before lawmakers, met with regulators, donated millions to political campaigns, and widely portrayed as the industry's white knight. While competitors collapsed, FTX announced rescue packages, credit lines for struggling firms, and created the impression that it possessed enormous financial strength. That image was largely an illusion. Behind closed doors, FTX and its affiliated trading firm, Alameda Research, was deeply intertwined. Although customers believed their deposits were safely held in the exchange, investors later alleged that billions of dollars in customer assets had been transferred to Alameda, which used them to finance highly leveraged trading, venture capital investments, political donations, luxury real estate purchases, and loans to company executives. Instead of maintaining strict separation between customer funds and corporate operations, the two organizations had become financially inseparable. The crisis accelerated in early November 2022 after a leaked balance sheet suggested that Alameda's financial position depended heavily on FTT, a token created by FTX itself. Much of Alameda's reported assets consisted not of cash but of its own liquid tokens. This raised a critical question throughout the market. If confidence in FTT disappeared, would both Alameda and FTX remain solvent? That concern became a full-scale panic when Binance CEO Changpeng Zhao announced that Binance intended to liquidate its large holdings of FTT. The announcement triggered an immediate wave of withdrawals from FTX as customers rushed to move their assets off the exchange. Billions of dollars left the platform within days. Unlike a healthy exchange that simply safeguards customer deposits, FTX could not meet the withdrawal request because much of the money was no longer readily available. Within less than a week, the illusion collapsed completely. FTX halted withdrawals, a proposed acquisition by Binance fell apart after preliminary due diligence, and FTX, Alameda Research, and more than 100 affiliated companies filed for bankruptcy on November 11, 2022. John J. Ray III, the restructuring expert who had previously overseen the liquidation of Enron, was appointed CEO. After examining FTX's internal operations, he stated that he had never seen such a complete failure of corporate controls in his career. The bankruptcy destroyed one of the largest crypto exchanges in the world almost overnight. Millions of customers suddenly lost access to their assets. Institutional investors wrote down billions of dollars. Venture capital firms suffered major losses. Regulators around the world launched investigations, and public trust in the cryptocurrency industry reached its lowest point since Bitcoin's creation. The collapse of FTX transformed the narrative of 2022 from a severe market downturn into one of the largest financial scandals of the modern digital era. The global fallout and crypto's fight for survival. The collapse of FTX marked the low point of the 2022 crypto crisis, but the damage extended far beyond a single company. Confidence in the entire digital asset industry evaporated. Investors who had already endured the Terra collapse, the failure of Three Arrows Capital, and the bankruptcies of Celsius and Voyager now questioned whether any major crypto institution could be trusted. The crisis had shifted from a problem of falling prices to a complete breakdown of credibility. The market reaction was devastating. Bitcoin, which had traded nearly $69,000 just 1 year earlier, fell below 16,000 in November 2022. Ethereum lost more than three-quarters of its peak value. Hundreds of smaller cryptocurrencies effectively became worthless. The total cryptocurrency market capitalization, which had exceeded $3 trillion during the bull run, shrank to well under $1 trillion. Years of gains disappeared in a matter of months, wiping out the wealth of retail investors, hedge funds, venture capital firms, corporations, and even governments that had accumulated digital assets. The corporate consequences were equally severe. Thousands of employees across the crypto industry lost their jobs as exchanges, mining companies, blockchain startups, and investment firms announced mass layoffs. Venture capital funding slowed dramatically. New token launches almost disappeared. While many decentralized finance protocols saw billions of dollars leave their platform, companies that had aggressively expanded during the boom suddenly shifted into survival mode, cutting costs and preserving cash rather than pursuing growth. Regulators around the world also changed their approach. Governments that had previously taken a relatively cautious stance towards cryptocurrency began accelerating efforts to strengthen oversight. Investigations into exchanges, stablecoins, lending platforms, and tokens issuers expanded significantly. Lawmakers argued that stronger consumer protection, reserve requirements, and auditing standards, as well as transparency rules, were necessary to prevent another crisis of similar magnitude. The industry's long-standing promise of operating with minimal regulation now faced its greatest challenge. Yet, despite the unprecedented destruction, the cryptocurrency ecosystem didn't disappear. Bitcoin continued producing new blocks every 10 minutes. Ethereum completed its transition to proof of stake. Decentralized networks continued operating exactly as they had before. While failed in 2022 were not the core blockchain protocols themselves, but many of the centralized companies that had built highly leveraged financial businesses around them. The crisis forced the industry to confront uncomfortable questions about governance, transparency, custody, and risk management. Whether those lessons would ultimately produce a stronger and more resilient crypto ecosystem would become one of the defining questions for the years that followed. Conclusion: The lessons of 2022 crypto industry crisis. The 2022 crypto industry crisis was not caused by a flaw in blockchain technology alone, nor was it simply the result of falling cryptocurrency prices. It was the consequence of years of excessive leverage, reckless risk-taking, poor corporate governance, and the assumption that markets would continue rising indefinitely. As long as liquidity was abundant and prices climbed higher, these weaknesses remained hidden. Once global monetary conditions tightened, the entire structure began to unravel. One by one, the industry's biggest assumptions collapsed. Algorithmic stablecoins were not as stable as promised. High-yield lending platforms were not risk-free savings accounts. Billion-dollar hedge funds could fail within weeks. Celebrity endorsements and stadium naming rights didn't guarantee financial strength. Even one of the world's largest cryptocurrency exchanges turned out to have fundamental governance failures that ultimately led to its collapse. For regulators, the crisis became evidence that digital asset markets required stronger oversight. For institutional investors, it highlighted the importance of independent audits, transparent balance sheets, proper custody arrangements, and rigorous risk management. For retail investors, it reinforced one of the oldest principles in finance. If an investment promises unusually high returns with little apparent risk, those returns are often being generated by risks that are poorly understood or deliberately hidden. Yet the crisis also demonstrated an important distinction. While centralized companies failed, decentralized blockchain networks continued functioning exactly as designed. Bitcoin never stopped processing transactions. Ethereum continued validating blocks. The protocols themselves operated independently of the companies built around them. This distinction reshaped the entire conversation surrounding cryptocurrencies, separating the resilience of decentralized technology from the vulnerabilities of centralized financial businesses. The events of 2022 permanently changed the cryptocurrency industry. They accelerated regulatory reform, alerted investor behavior, forced greater demands for transparency, and eliminated many of these excesses that had accumulated during previous bull market. Every future crypto cycle would be measured against the failures of 2022. The collapse became the industry's defining stress test, a reminder that financial innovation doesn't eliminate the fundamental principle of economics. Leverage still magnified losses, liquidity can disappear overnight, trust is difficult to earn and easy to lose, and no market, regardless of how revolutionary it claims to be, is immune to the consequence of unsustainable risks.